Do you want to know which portfolio idea is the best for you, but you don't know exactly how to do that? Don't worry, there are different magic numbers that can help you decide which portfolio is the best for you. And the last one is my favorite. The two basic variables in a portfolio is the average return that your portfolio has and the average risk or volatility that that portfolio has had in the past. All of this is based on the modern portfolio theory used by many asset managers and also made fun of by famous investors like Warren Buffett. We will look today at the theory, and in practice you will be able to decide which side is the best for you. We're going to use a spreadsheet that I have and that will be available for you to download in the description section. So first, what do we have in this spreadsheet? We have raw data prices, statistics, and the matrices. On the first tab, we have different stocks that I have chosen for demonstration purposes with the prices of those stocks from January 2012 until March 2022. So you have all of these and you can choose other stocks to use for your specific portfolio. Then in the statistics, I have calculated the return of every month for every single stock, as you can see, as well as the average return of the stock, the variance, and the standard deviation risk, or also called volatility of the stock. Finally, here in the matrix, which seems like it is very difficult, but it actually isn't, you will have what are the returns of each stock and different portfolios that we are going to look at today. The formula of calculating the return of a portfolio can be found here. In order to calculate it, you have to calculate the weight of every stock multiplied by the average return of that stock and add all of them together. We are going to use this thing called matrix to facilitate this calculation. So you can put the data and the spreadsheet will calculate the return and the volatility for you. But in case you want to know the formula for return and risk, you can find them here. Now, the first magic number is named the Sharpe ratio. The formula for the Sharpe ratio is this one, which basically means that you have the return of a portfolio minus the risk-free rate, which is the treasury yield, and we are going to divide that excess return of your portfolio by the volatility of the portfolio. What does this magic number tell you? It tells you how much additional or excess return do you have for every point of risk you are taking. Ideally, you will want to have the highest Sharpe ratio possible because you are getting the most amount of excess return for the risk you are taking. But the last magic number that is my favorite is the Sortino ratio. Why? Because the Sortino ratio does the same calculation, but instead of using the risk-free return, it uses the return of the benchmark. In our case, it will be the S&P 500 index for practical purposes, and it divides it to the downside risk. Why? As you can see in this image right here, having a Sharpe ratio can mean a lot of things. You can have a portfolio that has done great for the last 10 years and another that has done terribly bad in the last 10 years, but they have the same Sharpe ratio. Why? Because the volatility, the metric, is using the ups and downs of the stock, in which case you don't really care about the ups because you make money when the stock goes up. You only care about the risk of movements that are going down. That's why the Sortino ratio uses downside risk. We are going to calculate the risk of the stock going down, the only risk that we actually care about. And that difference makes the Sortino ratio more relevant. Because as you can see in that image, you can have two completely different portfolios with the same high Sharpe ratio. So the first thing you would want to do is put the stock data in the spreadsheet. Then it will calculate automatically, and you can see all the different formulas here that are calculating the returns, the averages, as you can see here, as well as the variance and also the standard deviation. Also, you can see in raw data prices, our benchmark, the Sortino portfolio, the excess return, and the downside. Here we have the return matrix. Don't worry about the formulas. We can make another video explaining specifically what we have done and what is the logic behind the modern portfolio theory. This is basically what is the average return of all these stocks, and we have different portfolios. The matrix sigma is looking at the covariance, which is how one stock is related to another stock, and we have all the different combinations as you can see here, and we have here the different portfolios. First, we're going to look at the portfolio with the maximum return, which is going to be pretty easy. The calculation will be which stock has performed the best during this time period, and you will put 100% of your money there. Then you have the portfolio with the least amount of risk, or minimum variance portfolio, and we are going to calculate using Solver in Excel. And lastly, we are going to look for the highest Sharpe ratio, our first magic number, and the highest Sortino ratio, our second magic number. So how do we do this? So we are going to use the Solver tool in Excel. What is our objective? Our objective will be the maximum return. So here we have the return. We will click this as the objective. Then, which cells do we want to change? We have the portfolio with the maximum return. So we will select all of these stocks right here, and we select enter. Lastly, we are going to add a constraint, which means a limit. We want the total to be equal to 1. This means that the sum of each stock allocation has to be 100, because you cannot have a 102%. You have either half in this stock, half in these stocks, 10, 10, 10, or anything that adds up to 1 or 100%. And we click add. Then we click cancel, and we can see our objective, the change in variables, and the constraints, and we click solve. You will let the machine do its thing, and it says Solver found a solution. We have the maximum return of 14.42, the variance, the volatility. As we can see, we have a high return but a lot of risk. The risk-free interest rate as of June 20, 2024, and this is the Sharpe ratio of this portfolio. As you can see, it is 0.24. But what has changed? How did it find it? It used what we call numerical solutions. As you can see, the GME stock is the highest one in this period, and we are going to put 100% into the maximum return portfolio. That is why it is so risky. Now we are going to do exactly the same thing, but we are going to look for the portfolio with the minimum variance. We go to data, the Solver tool, and we are going to do everything again. We're going to delete the objective. Now the new objective is the minimum variance. We click here. We want the minimum. We're going to delete the change in variables. Now we have the portfolio of the minimum variance. These are the weights. We're going to select all of them, enter, and we are going to delete this constraint and add that the total of this portfolio has to be equal to 1. We add, cancel, solve. Now you can see the minimum variance portfolio, and as you can see, it is changing the values. Solver found a solution. Okay, so this is the portfolio that we have in order to have the minimum variance. As you can see, the comparison between a 147% volatility to a 2.95% volatility, it's huge, but the return, of course, it's almost 14 times less. Now, as you can see, comparing that return to the maximum portfolio, it is pretty low, and we have a higher Sharpe ratio. We have changed the risk-free interest rate to be monthly in order to have the calculation work as it's supposed to, and we can see that the Sharpe ratio of the maximum return is not even close to the Sharpe ratio of the minimum variance return. This means that you will get more additional return for every risk assumed. So the maximum return, even though it has the highest, it is not the best one, using the Sharpe ratio as the metric to value which stock portfolio is best. Then we will look at the maximum Sharpe ratio. We're going to use the Solver tool. Set objective, it will be the Sharpe ratio. We want to maximize. Also, we want to choose the new portfolio, which is here, maximum Sharpe ratio. We're going to choose all of these values. We're going to delete this constraint and add the new one, which is here, total equal to 1. We're going to add, cancel. We can see that everything is okay. Solver has found a solution. Here we can see that we have even a better Sharpe ratio than the minimum variance. We have a higher return, but of course with higher risk. But if we compare having an additional 0.98 return for every point of risk to having 1.66 return for every point of risk, it is better for you to use this portfolio right here. You can see the weights. You should put 3% in this stock, 11% in this stock, 12% in Tesla, 33% in Visa. And that's how you find the maximum Sharpe ratio with the stocks that you choose to have in your own portfolio. Remember, you can add or have less stocks in your portfolio by just dragging the equation to having more stocks, but the formula will still be the same and you'll have the exact same result for you. Finally, using my favorite metric, which is the Sortino ratio, how does it work? We have our benchmark. We're going to use the S&P 500, the ETF SPY. Just for practical purposes, the benchmark may be another one, and we can see the returns of this ETF in the same period. The Sortino portfolio are the weights that we're going to change soon. The excess return is how much return does the Sortino portfolio have compared to the ETF. And the downside is, as you can see, if this excess return is negative, then we're going to consider it. If the excess return is positive, it is a good thing. We shouldn't calculate that risk because the risk of earning more money, does it make sense? Not, right? And we're going to drag all of that formula right here. And the formula can be seen right here. It looks complicated, but it actually is pretty simple. We have the average of the excess return right here, divided by the standard deviation of the downside risk, and we're going to analyze that return. Now we're going to use Solver. What is the objective? Our objective is the Sortino ratio. We want to maximize it. We're going to delete the change in variables to the new portfolio that we find right here, portfolio max Sortino ratio. We click enter, and we're going to delete this constraint and add the new one, which is the total has to be equal to 100%. Add cancel. And we are going to let Excel do its thing. And here we have the solution. We have the portfolio weights of what you should invest in order to have the highest Sortino ratio. We can see that we even have a higher return, of course, with a higher total volatility, which it doesn't really matter to have the total volatility in consideration, only the downside volatility. And that's how we arrive to a 6.42 Sortino ratio. That is why you should look for the highest Sortino ratio portfolio. I believe it is better than the Sharpe ratio because, as we have seen in the previous example, having the total risk upside and downside is not very useful for you. So you can have a portfolio that aligns with your preferences, your profile, and that has also the highest Sortino ratio. Remember, using Solver, you can add more constraints. If your profile or your preferences is, I want to have 30% maximum in this specific industry, you can add it and the calculation will be the same. Now that you know how to analyze which portfolios are better than others using specific metrics like Sharpe ratio and Sortino ratio, you might be wondering, what investments can I choose to put my money into? If you want to look at the most common and popular investment vehicles out there, their nature, their pros and cons, click here to look at my investment tier list with my profile and my preferences. That's it for today. I hope you have a great day. See you all in the next one. Ciao, ciao.